Good afternoon, everyone. It is Friday, July 18th, 2025. We got Infra back with another video here. We're going to talk some macro. We're going to talk markets. First, if you can, please give the video a thumbs up. Don't forget to like, comment, subscribe to the channel. Come find me on carnivoretrades.com for swing trading alerts, analysis, and live day trading. Don't forget to come find Infra on his channel, Infranomics, Economics Unmasked. Infra, nice to have you back. How are you doing?
Hey, good to be back. Yeah, it's exciting times.
It is. Last time we were here, we were talking about the we were talking about the Liz Trump moment, and I want to say that was back in what was it, mid June? It was a
Yeah, about
little
a month
over,
or two ago.
yeah, a little over
Yep.
a month ago. Yeah, so we had a pretty good melt up towards the end of May. A little minor pullback, little consolidation since then, and we just kind of been off to the races. And a lot of things to discuss here. And today, right now, Friday, options X here for the month of July. And we're pretty much pinned to 6,300 SPX right now. It's about we're into power hour right now, and we're not doing anything. It's OPEX day, so we know not to expect too much there. But right now, yeah, I just want to get your thoughts on. It's everybody's kind of talking about it right now, but we're pinned to 6,300. But is there some maybe like emerging market style upside risk here? We had a little bit of a dip middle of the week, whipsaw Wednesday type action. It was bought pretty fast. Are we looking at some melt up here, or can we get a pullback here with maybe some positive gamma rolling off?
Yes, so emerging market like dynamics are kind of been my base case since September, October last year. I think I put out a tweet saying the US is more akin to a third world emerging market than most Americans would like to admit, something along those lines. And for a number of reasons, clearly, this transcends politics, in my opinion. This goes back to the prior administration. That we've been seeing the kind of groundwork laid for something like this for a while. I mean, we had under the last administration a run it hot sort of approach. We had the S&P, perform outrageously strong on an annual return basis for 2 years in a row. And like when you look at a long-term chart of something like the S&P 500, it's on this like crazy long parabola. And it looks strikingly similar to like the Nikkei leading into 1990. For those that aren't aware, following 1990 in Japan, there was an everything bubble bursting, and of course, it did not continue, but it did look like this kind of going into it, and like this has kind of been like my base case for a while now, going back into the last administration, mainly for fiscal reasons. You can get a nominal U.S. dollar return that looks like this. You can get a chart that looks like this. This is the S&P 500. You can get this, but the denominator, if the denominator is failing, right, you get stuff that looks like this. This is the Turkish stock index, and we were talking this period of time here in just a couple months in 2022. It had 135% return. It's so hard to see. You have to kind of look at it on a log chart. And it just looks crazy. Well, this is what happens when the denominator, the Turkish lira in this case, is failing. And I've looked at Argentina, I've looked at Lebanon, Turkey, and even Venezuela. It was a bit hard to source some of that data, but the general trend is kind of the same, which is in local currency terms, things can go to the moon. The issue becomes when you denominate it in something other than that local currency. Like here is that same index denominated in dollars and then denominated in lira. So when the currency is failing, you can get some really face-ripping sort of rallies in nominal terms. But I think the key is going to be for people to do things like use gold as a denominator because, and this is gold in lira terms, so we're crossing denominators, but
Right.
I think that's really going to be the key. Whether it's treasuries, pushing 5% on the 30-year. We were talking last time that this looks incredibly bullish. The chart on rates, at least, which this would imply TLT, hitting a fresh low. So yeah, I think the long end. Something I was looking at earlier today is the U.S. 30-year minus the 10-year. It's not a spread that's super talked about very often,
Yep.
but just going back to the beginning of the year, it's gone from 15 basis points to 57 basis points, and so the steepening is pronounced even between the 30 and the 10. Like the long end, the furthest end of the yield curve is really making moves, like not just in the U.S. but also in Japan as well, and some other developed markets. So I think changing the denominator in a case where the denominator is failing, I think is going to be critical. Whether it's real estate, whether it's S&P 500, which in gold terms is down, going back to the .com bubble. So stuff like this, right? You can get a rally that looks crazy in U.S. dollar terms, but if you look at the S&P in gold terms, you are down significantly from this peak 25 years ago. You're down 65% if you bought up here. So I think it's all about the denominator and how people are looking, what benchmark they're using for returns. If you don't care about kind of real returns and it's just you don't mind the optical illusion, well then yeah, I would say I'm kind of half in between. We're about to top out here, and half in the camp of we're just gonna melt up over the next couple of years.
Well, and in terms, well, so in top out, you just mean, are we, well, obviously we can have pullbacks and so on and so forth, but so you're just saying like in the macro sense, I agree with that. I don't think that, I think markets are just designed to go up, but yeah, obviously it can be exacerbated when you have this much debasement. But at least just in terms of the near term here, if you're there's somebody who's a trader or maybe a swing trader, it does look like that, and I've shared this chart before recently, but we have, pretty much across all expiries, S&P, there's definitely a little bit gaining at 6,500 at that strike. And if we can hold above 63, we will go there, and it seems to be the case. So, we do have some we do have some positive gamma rolling off today. So it just kind of depends if we can get a pullback here into some weakness. But I think a lot of people front ran that expiration, and they tried to kind of front run that window of weakness, and that's another kind of supporting thing for the market. If too many people are in the know, then it is like it has a vol dampening effect.
Yeah, the chart we were talking about earlier, the CTA chart, I
Yeah,
think that's probably applicable as well.
yeah,
Which is, if you have big players kind of behind the curve that need to catch up with equity exposure, things could get pretty wild, I think. Especially because they're psychologically they're basically getting short squeezed. Because in a way, if you're in say cash, and the equity, the S&P is ripping higher. If you're in cash and the S&P is ripping higher and you're underexposed, and you're benchmarked to the S&P 500, then you're basically short, right?
yeah.
And so there's a psychological element where and just pull up any short squeeze and they can get pretty violent.
Right, and even if you're long, but you have too many hedges, too many short hedges, that is effectively eating a hole in your pocket. And again, then you have your clients calling you, hey, the S&P, and here's a little fun little fact. In the last 3 months, just over 3 months, ES is up 31% as of today. And so you're trying to short, you're trying to hedge against a market that's going up where your currency is going down. So now you're losing double, and you got your clients calling you, hey, why aren't you in Nvidia? Why aren't you in Broadcom or any of these these stocks have ripped, right? So
Yeah.
there's that factor as
Yeah,
well.
I think also there's the international story, which is really important. So here's the S&P in dollars, right? And everyone knows this is a pretty bullish looking chart, broken out to new all-time highs, up 31% since that
Yeah,
Liberation Day
yeah,
bump. But if you look in euros, right? If you're a European investor or you're a Japanese investor, you are still well off the all-time high.
Yep.
Here's in yen, and the yen has strengthened, or the dollar has strengthened versus the yen recently. So this chart has come back, but like in pounds and in euro, you're still 4, 5, 6% off the all-time high. And so like there's a degree of there's a global story as well, which is the kind of de-dollarization. The world had gotten so overweight U.S. equities, and global U.S. equity exposure had gotten so stretched, and the dollar too had gotten kind of so overvalued. I mean, leading into the past couple months, where we've seen this pretty significant weakening in the dollar on a purchasing power parity basis back here was actually more overvalued than it was in 1985. And for those that are not aware, 1985 was the Plaza Accord, and I will show, this is what happened to the DXY. It was as high as 164, and within a year or two, it was down as low as the mid 80s. Yeah. This was following the Plaza Accord. So the dollar was actually more overvalued recently.
Do we know what our debt to GDP was back then, off the top of our heads?
It was much lower.
Yeah,
much lower.
That's safe to say it was lower, right?
Yeah, much lower.
Our personal savings, I'm sure, was much higher, right?
Yeah, the current account deficit.
Right.
Yeah, so like there's a degree to which foreigners rotate capital, and these things move very slowly. But if the dollar weakness, which by the way, I think I did call I've been very, very bearish on the dollar going back to December, January. That call has been correct. I did call a bottom, like a short-term bottom here, but I'm starting to think like the sell-off might continue, maybe not immediately, but like in the next couple months, we might just see this uptrend get broken. And like when you have dollar weakness as a foreign investor, you've got to worry about your currency risk, but then also the nominal, like local return in local currency terms. And a lot of this equity exposure was currency unhedged. Close to $10 trillion of U.S. equity exposure was currency unhedged. So if you get prolonged weakness, another down leg in the dollar, that could spur selling by foreigners. So I think that there will be like a headwind from those foreigners, that foreign story or that global story will serve as kind of a headwind. This is one of the reasons I'm not like mega bullish, or personally, I wouldn't want to personally be invested in U.S. equities, is because I still think that this is kind of this like lingering headwind probably for the next couple of years. Now, that's not to say that the S&P can't, have strength and go to new all-time highs and, all that, but I just, in real terms, like I think that what you want to own in a true kind of debasement sort of world is the scarcity. And if you look at the S&P in gold terms, like it is not the best chart,
Yeah.
like even including dividends here.
The funny thing is too, if you said that to somebody, like they wouldn't believe you unless you showed them the chart. There's no way that gold, but it's true. It's
especially
right there.
A boomer.
Yeah,
right.
Like,
especially like,
well, they always draw the line from like the low in 1987. It's like, well, okay, that's a cherry picked. How about we draw it from the high in 2000?
Yeah, well, and
You know what
the
I mean?
other thing too that I've kind of that's been influencing the way that I've been looking at U.S. equities, at least, is politically. So back in 1965 into the early 80s, this was really the last kind of period of populism. And we had the Guns and Butter and the Great Society and all these. Chem talks about a lot of this. We share
For sure.
some of this framework. And if you look at S&P in gold terms, it went sideways from 65 all the way through like 6-7 years, right? And then of course there was the Nixon shock, and you could think of the Nixon shock as some. I don't know what it'll look like this time. It certainly won't be called the Nixon shock, but there could be something analogous to this, right? That has to do with the fiscal. Maybe it's an unruly bond market or something. I'm not in the failed auction camp, but maybe it's something dramatic like that. Who knows? But if you were invested in U.S. equities here, let's just pick kind of the midpoint of that range. down to there, you lost 86% in real terms. If you use gold as the real, the real inflation rate, you lost 85% if you were in U.S. equities.
It's
I mean, that
basically
is a brutal,
it's
that's a
basically
brutal
yeah.
sell.
It's like altcoin losses.
Yeah, yeah. In the
Yeah,
S&P.
yeah.
Um, so yeah, I think, and I think that that's, the current administration is quite populist. It's not that populism is a bad thing, in my opinion. I would say that, personally, some of my leanings are very much in the populist sort of realm. A lot of people consider me one, but just objectively speaking, like it's not good for financial returns, right? For financial assets, like it's generally inflationary, and depending on is it your flavor of populism or the other guy's flavor of populism, it doesn't really matter for financial markets. But your personal opinion on the flavor will vary quite a bit depending on if it's your flavor or not. But for financial markets, like the end result is the same, which is it's very inflationary. I mean, if you look at like U.S. corporate profits as a share of GDP during this period of time, both the S&P 500 as a share of GDP and corporate profits as a share of GDP, like they went down. Like I know that's really hard to believe in kind of our in our modern day world, that corporate profits as a share of GDP actually declined. Um, but they did, and they went sideways. It wasn't until very recently that corporate profits versus, as a share of GDP started to basically doubled over the past 2 decades, going from 5% to well over 10% of GDP. But during this period of time, it was not good for corporate profits. It was not good for the S&P 500 relative to GDP.
Well, and
Financial
it
returns.
looks like it started to turn up right around the early '90s when we started doing globalism, which we're doing the
Yeah,
opposite of now.
yeah. So here's the S&P as a share of GDP as well. So S&P denominated in GDP,
Hmm.
and it's the same. It's really the
It's the
same story,
same.
which
Yeah,
is, yeah, like around the 90s.
yeah.
It's not, you could argue that the 80s were really a big turning point, with some tax reform and the start of globalism. But globalization really kind of accelerated,
Yeah, they didn't
like
get
you said,
it.
in the
Yeah, they
90s.
didn't really get it like running and like fully.
Fully,
Yeah,
yeah, yeah, yeah. And then it's just off to the races. Corporate profits, greatly outpaced GDP. S&P 500 greatly outpaced GDP. They were able to arbitrage global labor,
A-
cost of labor. So
and the consolidation of corporations, right? Like there was all sorts of department stores, banks, you name it back then, and I mean now there's like nothing. There's just conglomerate A and conglomerate B.
yeah,
I mean, I
oh,
remember
for
growing up, we
sure.
would go to the grocery store. There'd be all sorts of, little, not mom and pop necessarily, but kind of like small regional chains and things like that. And they're all gone now.
Yeah, small and medium-sized businesses have just been getting absolutely decimated. I mean, some of the regional bank, like small and regional bank data
Yeah.
is crazy. If you compare how
You,
many regional banks there were back in the 60s, 70s.
well, and before '08, I mean, it's like there's like a tenth of them now.
Yeah, 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 exactly. Yeah, but like that, this has been great for certain parties, right? Here
Hmm.
in purple is the net worth of the top 1% relative to GDP. The net worth has outpaced GDP, to a significant degree. That financial assets and those that hold them have outpaced GDP to a significant degree, and of course, corporate profits here in white have outpaced GDP. They've doubled, right? Just over like the past 2 decades, they've doubled as a share of GDP, and so, we're entering this kind of world where I think, regardless of who's in power, there will be more populism. And in general, as we were seeing from that S&P, the S&P denominated in gold, in general, that's the kind of time where, in my opinion, the stuff you really want to be in is not U.S. equities or certainly bonds, but bearer assets that have so that you have sovereignty over your own personal wealth, and those bearer assets better have scarcity. And if there's hey, collectible guitars or Pokemon cards, or it doesn't have to be gold and Bitcoin. I mean,
Right.
some of those things did really well in the kind of 2020 into 2022. I forget which one I was looking. I was looking at some strange, like, bizarre collectible world, and it was like, yeah, prices like tripled in those couple years following 2020.
Yeah, absolutely. And one thing that I think Warren Buffett said this, and I'm sure a lot of people have too. But invest in what you know. If there's a niche that you know that can be exploited, if that's Pokemon cards or if that's whatever it is, there's ways to I guess it doesn't have to always be gold and Bitcoin. It doesn't have to be real estate. There's things you can do to protect yourself and beat the market even.
Yeah, I mean, gold, it's hard. As I was having this conversation with someone I know in real life the other day, and it's hard here because like gold has ripped pretty hard. I mean, look at how
Hmm.
overbought it is. It's 86 on the monthly time frame. So
But
it's very overbought
it did base for 15 years to do that. I always remind people of
for
that.
sure. Yep, yep.
It's not just going to stop after 1 month. It took a long time to get this. So
Yeah, and the fact that it is, I mean, this is a pretty picture perfect
right,
little pennant sort
right,
of consolidation, right? That it's held up here. I think it's very bullish, and like this doesn't look as crazy to bid gold on on a daily chart, right?
right,
But when you look at the monthly chart,
right.
it looks a lot, and the same thing is true for Bitcoin. It's tough to go in and go if you're not already exposed to something like gold or Bitcoin. It's tough to go in here, right, and start buying. But I've recommended that if people don't have, the friends I have in real life and stuff, is if you didn't listen to me in 2022 when I told you to start buying gold and Bitcoin, if you didn't listen back then, and you have zero exposure, then you just kind of got to do what the boomers did: pick quality things that you think will do well and just dollar cost average, because the denominator kind of must continue to fail from a fiscal and debt dynamics perspective. And so you just find strong uptrends and you just dollar cost average in. And when it dips, you have
Yep.
conviction and you add more and you bring your cost basis down. And I mean, since 2022, gold has doubled.
Look,
I mean,
you can. I was just talking about this. Somebody asked me in our trading room the other day about gold, and I did kind of a piece on this a little while ago. But if you go back and look at if you scroll back on gold and look to like the early 2000s, the run up to 2008, it breaks out. I think we're still looking at Bitcoin here, but
this is
oh,
Bitcoin
okay,
over gold.
okay. But if you look at just gold prior to 2008, it has this run up. It has like kind of a flag in '06. It breaks out, and then the GFC, it essentially just retests that breakout because of a volatility event, right?
Here.
Yes. Now, if you scroll to your right just a little bit, yeah, right there, that's that retest. So the other thing would
Oh
be to
yeah.
say with gold, when you get volatility, when it gives you that opportunity and volatility, if we ever get back to anywhere near 2000, but that's your chance, that's your cue. If there's because obviously fundamentally it's probably not going to go that low. It's going to take a volatility event, right? So
Yeah, correlation
take
in
advantage
a
of that.
yeah, in a correlation to one sort of environment, I could see a pretty sharp pullback. I don't know about 2000. Maybe like mid 2000s, I could see something like that in a correlation to one sort of world. But yeah, I like it's hard, because I have such high conviction in kind of the direction for the next decade, being this, fiscal dominance, financial repression,
Hmm.
denominator kind of failing, and all this. But for normal people, it's hard if you I joke, but like I tried to tell everyone I knew back in 2022, back here, I tried to get them to buy gold at 16, 1700, and they thought I was crazy, right? I tried them
Yep.
to get them to buy Bitcoin in like the 40s and 50s. Right. Here was the ETF somewhere in there, and yeah, and like people just didn't. I don't know. They didn't listen, and so it's harder now, right? Like psychologically, it's harder to. Yeah, like I don't really know if it's hard to put myself in their shoes and just kind of have no exposure, right? And maybe a 401k or something. Looking at what I'm telling them, I think is likely to happen, and kind of the direction things are. looking at that, having really kind of not prepared at all coming into today, say, it's hard because these things that are both of these charts look really strong.
Yeah, and until they're not, that's when you're at an all time high like this and you're going parabolic, it's you just gotta wait for a reversal, really. You can't really. I mean, there's things we can do to look for possible targets, but like I've done this for a long time, and I've called tops successfully to the tick. I've also thought something was going to top out, and it went up another 50%. So it really just has to. You just have to wait for it to happen, and that's when you got to make your move, and you got to be ready.
Yeah, but then there's these, right? There's these
Right. Well, I don't think
these
we're quite there yet, fortunately. But
yeah, I mean,
yeah,
look, the Trump administration, that's a 300% move in like 2 years. Uh, the Trump team is talking about cutting the federal funds rate by
let's.
300 basis points with unemployment at 4.1 and core CPI
Yeah,
2.9.
I can't wait to ask you about this because we had this loaded up here. So I mean, this is like, I mean, I feel like this is like a daycare right now. And Trump, right? People who know Scott Bessent is like he worked with George Soros, like the biggest hedge funds ever. He understands the bid ask, right? He's been in the trenches before, right? He knows how Fed funds works. Shouldn't shouldn't Trump has to just be using Powell as a scapegoat. There's no way he doesn't know how Fed funds works. Am I crazy or what?
I don't know.
Because you,
I think some of these people like Pulte, Kevin Hassett, the more like clowny sort of people,
yeah,
I think they genuinely think that if they cut the federal funds rate, that the long end will go down. I think they genuinely believe that.
yeah,
I
and
think Besson knows to your
yeah,
question.
yeah,
I think that
he
Besson
has to
might
know.
know. Yeah, yeah. But like the clowny ones, I think they legitimately believe, yeah, oh, we'll take the federal funds to zero and the long end will go down.
And they're talking about having Bessent be the Fed chair. That they're going to be surprised.
Yeah,
I
I just I don't think personally I don't think that he's going to be the
I
Fed
no.
chair.
Did you
I
hear
think it'll
Waller?
be yeah, I
So
think it'll be
Waller today, yeah, he became the next Boy Scout. I will vote for a July cut, and yeah, I'll accept the job if I'm nominated. So we got our next Boy Scout.
yeah, I think that he's been auditioning for a couple months now.
Yeah,
I want to say it was like 2 months ago that I kind of started to notice that he was seemingly auditioning, and he's turning pretty tough. Even Kevin Warsh,
yeah,
who historically has been pretty hawkish with going back to like the GFC, he's been pretty hawkish. Even Kevin Warsh is turning dovish, and it's like you see all this happening, and someone like Kevin Warsh, one of the biggest Fed critics, going dovish in this environment with core CPI at 2.9 and unemployment at 4.1, and you just kind of you start to it's just clown world dynamics. We're entering that sort of dimension where things just go into la la land, and they do things like cut the federal. I mean, that's what they did in Turkey, right? Like they basically and for context, back in the 40s, back during World War II, we had high debt to GDP. We accumulated high debt to GDP going, because of World War II.
right.
Well, coming out of that, they ran negative real rates. They ran yield curve control. They capped rates at 2.5 for the long end, and I think the short end was like 37 bips for shorter maturities. And the Fed would just print as many dollars as required to hold those rates, to hold those yields, and it was just full blown fiscal dominance. There was no illusion of Fed independence, and eventually, like the Fed kind of, inflation was quite high. We can see back then, I want to say it was like 18% nominal growth, and the Fed was getting a little dismayed at what was going on. Yeah, here in 46, inflation was 19.5%. And
But
so
just to
eventually,
note, there was at least production. Like there was at
for
least,
sure,
yeah.
yeah.
Unlike now, which makes it worse.
Right. We did not run a massive 6% of GDP current account deficit back then. we could actually
Right,
make things.
right.
And yeah. So it was definitely a different scenario, but like it eventually got to the point where the Fed kind of demanded sovereignty, and there was a 1951 Fed Accord between the Treasury and the Fed. I think it was yesterday or today. Kevin Warsh came out saying basically we need a new Fed Accord, but this time it would basically be going in reverse, kind of neutering or
Merge, yeah,
sterilizing.
yeah, merging
Yeah,
the Treasury and the
Fed.
Fed, yeah.
Yeah.
What I was going to say, you made me just think of, we were talking about the latest inflation data, and, okay, maybe it came down, it's probably cooked, but, maybe it came down, maybe it didn't. We had retail sales come in better than expected, but why, I don't think they're ever going to care because there's another problem here, which is called Uncle Sam's capital gains tax, right? They can't let the markets go down.
Yeah. So if you look at retail sales in real terms, and again, even using CPI, which is, I think, a flawed denominator or a flawed deflator for calculating actual inflation. Even if you use the CPI deflator, retail sales do not look that great, right? They, again, going back to that kind of denominator story, they look great in nominal terms, but once you look at in real terms, even using the government's own flawed deflator of CPI, it doesn't look like all that strong to me. We have PPI that has producer prices bottomed over 2 years ago and have just basically been in an uptrend since then. You have core CPI basically 50% above the Fed target of 2%. And they're talking about taking the federal funds down by 300 basis points.
To
You have
1%.
unemployment
Yeah.
at 4.1. I mean, this is it. This sort of level on the unemployment rate is like unheard of. You have them talking about taking the federal funds rate down by 300 basis points with historically low unemployment. Now, you can get into the thing of like, well, headline unemployment doesn't accurately, you got to look at U6. I would agree with that. Like actual unemployment is significantly higher. U6 is running at 7.7. But yeah, look, like I think the point here is the same, which is they're apparently they're not worried about kind of going la la land. And I mean, I just don't see the case for 300 basis points.
Well, because the short end's not going to fix anything, and it's like they know what the problem is. The problem is the long end, people not being able to get other countries to buy our debt, right? But why is that? Because of fiscal spending, right? It has nothing to do with the Fed. It has absolutely nothing to do with the Fed. It has to do with the trillions. I've lost count of how many bills they passed. What is it? It's all just like numbers at this point because it's just so much. That's the reason why the long end is up. It has nothing to do with the Fed funds.
Yeah, and in fact, when they started cutting the Fed funds back in September, right before the last election,
The long end went right up.
it was
It
the
went right
bottom.
up. Yeah.
Yeah,
Yeah.
and the 10-year went up like 100 basis points.
Well, we only
After
cut by like 50 basis points.
that first
Well,
cut.
yeah. What was it like? 75 total.
It
It's
was
like
100 total.
Oh, was it 100? Okay. All right.
Yeah, 50,
But still.
25, and then 25. But yeah, but in the face of 100 basis points of cuts, you had the 10-year and the 30-year go up by 100 basis points. This has never really been seen before in modern history. I think that, if you look at the current kind of monetary policy as a cutting cycle, which I would agree we are in a cutting cycle, then, especially if you believe if you listen to what they are telling you we're in a rate cutting cycle. If you look at it in those terms of, okay, we're in a rate cutting cycle, then, really since this rate cutting cycle began, we have had a bear steepener. Now, you have to exclude bills, which, we had the inverted curve and all sorts of weirdness. But if you exclude very, very short-term bills, even at looking at like the 2-year out through the 30, we've been in basically a bear steepener since the rate cutting cycle began. And that's not bullish for bonds. And as you can see, the 30-year is just really what's kind of driving this. The 30-year, every time I look at a chart of the 30-year yield, I still cannot get over how strong it looks. So I think that long-term bond just continues to get smoked.
And I think that like the scary thing here is that, like you said, I agree we're in a cutting cycle too, but the what started this all was basically like a panic event, right? And what happens if there is another inflationary panic event and the 2 year goes up? Then what?
Yeah, I don't. Yeah,
Then what do you do?
that. Yeah, the I think that if they, I mean, it's important for people to remember the Fed, in my opinion, just kind of follows the 2 year. So I will take basically everything off
Oh, for sure. Yeah.
except
Yep.
for the two
Yep.
year. You
Yep.
can see the 2 year
Yep.
moves before the Fed. So yeah, like I could see a world where they pulled a shadow Fed concept. They announced this guy, 7, 8 months early. They have that guy go out and just be mega dovish. Oh, we are going back to QE, ZERP, zero
Right.
percent federal funds rate, and the 2 year I think would act on that. It would start to work to price that in. But yeah, like there's I think it's more of an issue at the long end where say the 10 year, the 20 year, the 30 year, like once we start getting kind of hotter inflation prints, I think that's where you could see things kind of get really spicy pretty quickly.
Yeah. On the short end, going back up despite their want to cut. I
Yeah, I
think that's
mean,
the problem. Is that what happens if there's something that forces the 2 year up, like some sort of macro event or outlier event that forces the 2 year to go back up. Then what do they do?
I think it would take a lot.
It would.
If you assume that we are kind of this la la land, cut the federal funds by 300 basis points, that is what they are telegraphing. That is the forward guidance that the next Fed chair is giving. If they are steadfast in this kind of mega dovish sort of world, I think it would take really a lot to get the 2 year yield, the 2 year to sell off, the 2 year yield
Hmm.
to move high. I think they would see a pretty immediate response in maybe like the 2 year, maybe the belly of the curve could see what they want, right? Which is lower rates. But the problem is, the things that most everyday Americans rely on, credit card interest rates, mortgages, car loans, these sorts of things are priced off the long end. So if you get a curve steepening and if you get long end rates moving higher, like they have been, then you get into a world where I mean, the housing market is already so soft, at least here in America. If the 30 year continues higher, like you get into a world where the long end rates are crushing the real economy so much. Meanwhile, yeah, you might have the federal funds down at, I don't know, 150 basis points or something. But if the 30 year is at 556, and it's crushing the real economy, then what do they do? Right. And so I think in that environment, which kind of comes second, first they are mega dovish, cut the federal funds rate by a lot to fiscal dominant, in an effort to service the debt, negative real rates. That's stage one. But I think that will inevitably cause the curve to steepen so much that eventually they're going to have to do like an Operation Twist sort of thing where they issue even more bills, which are much less volatile, much more easily levered into U.S. dollars for because being the collateral
Yeah.
for the system. So I think there is so pro liquidity to shift all the issuance into bills, and I would say negative for the dollar, that eventually they will have to issue even more bills, right, to raise dollars to then go buy down long end rates. And that's even more inflationary. So either they do an Operation Twist sort of thing, or they just say F it and just go full QE, right, and expand the balance sheet. I'm not sure yet. I think that both of them kind of functionally have the same result, which is they're very pro liquidity. They're very inflationary.
And I believe, speaking of Jem, he actually did a post recently about that would be likely the case where everything shifts to bills, but that brings its own problems in the swap market.
Interesting. I would have to watch that. I like. I know Chimp gets a lot of hate, but I think he's a smart dude. I think everyone is worthy of consideration. I'm not an expert in the swaps market, so I would have to watch that to hear his argument. He's definitely a smart guy. I might not agree with him on 100% of things, but I don't know. I fall in the camp of like the way that I learned so much was by listening to everyone, even the recessionistas that were proven wrong for 4 years, right? Since I started paying attention to macro in 2020, like these people like just will not give up with the
Right.
recessionista. I
Right.
still listen to them, right? Like even still, I listen to like DDM and
I did a it's a side note, but I did a tweet. And it was a poll last year in September, and I said like, which will happen first? Carvana reaches all-time highs, or we go into a recession? And Carvana was 249% away from all-time highs at that point, and it's I think about 5% right now. And the reason I chose that stock is because it was kind of like the poster child for like bankrupt, the worst, like
junk.
fundamentals, yeah, and you know that was the ultimate like macro short, you know, and it's right now like $10 off its all time high as we sit right now, and that was only in like 9 months ago.
Yeah, those heavily shorted, unprofitable tech, like the real junk of
Yeah,
the junk,
it
is
went
what's
it went from 370 to three, and then back to 370.
yeah, that's what's I saw a chart of I think it was unprofitable tech that Zero Hedge put out, and it was just
Yeah,
like I was just going parabolic.
yeah.
And yeah, look, like I just think that there's better um I do agree that we're kind of entering like La La Land sort of thing where you definitely don't want to be in bonds. But like I just don't think that equities are really what I mean, maybe yeah, if you can pick the equity, right? Like the single name, and you're good at that sort of thing. I'm not, right? That I'm not in the micro world, so that's not something I feel super comfortable with. But yeah, look, like individual names could do great throughout this, especially if they have a if you get lucky, and if they have like a decent business model and cash flows and stuff, you could see like solid outperformance where they actually outpace gold and they post a positive return in gold terms or in Bitcoin terms. I just think it's going to be really hard to do that, for someone like me at least.
Yeah, you're gonna need to basically catch like the next hype sector, you know, like obviously AI in 2023, things of that nature. And if you're good at that, that's, you know, something you can do. Like there's definitely gonna be
Yeah,
winners and losers. There'll be winners every, you
for
know,
sure.
in every type of market.
For sure. Maybe quantum is the next thing. I'm kicking myself because I actually I have the email too. I emailed my dad about I think it's QBTS and some of the
Yeah.
big quantum names that are up like hundreds of percent. I messaged him about like 2 years ago, and and I looked at the chart. I put an arrow to remind myself of like when I sent the email.
Yeah.
I was just kicking myself for not. Because I don't know, it's just not what I have the most confidence in, right? Like, I was just looking at the charts and kind of thinking generally, well, yeah, quantum probably is gonna be maybe the next thing. So, but like in terms of my own money, like the thing that I have full confidence in is that like stuff like gold and Bitcoin is just, for me at least, and the way that I approach everything, it just seems like a much safer bet, than than any equity could.
In terms of investment, yeah, for sure. I mean, hey, but don't kid yourself. You're a good trader, right? You
Yeah, I with YouTube, like the dirty secret for me at least. I don't know if this is true for you. I don't really love trading. Like it, I got to a point where I was okay, right, and I was like profitable over, reliably profitable and stuff. But like the stress, right, like the psychological side of it, was kind of like it was taking a toll. And then I started the YouTube, and like because it just took off so quickly, got monetized so quickly. Like I started, I'm making like in addition to my day job, like it's a decent second income stream already. And so like I started getting income from YouTube, and I was like, oh, I don't even really need to trade. I just kind of put everything, excess savings into like gold and Bitcoin, kind of continue to build those positions. And like, I don't even really, I took a trade today. I was in some 0 day spy puts that did pretty well. But yeah, like I've done, that's the first trade I've taken in a couple weeks, honestly. Cause yeah, with the YouTube thing, it's like so like I sit back, I watch the like YouTube studio chart, and I'm just like, it's so nice That I don't have any. I'm not going to lose money, right? Like if I'm wrong, it's just
Right.
it's no, it's not a lot of
You
money,
you've
but
done really well. I think your field is better suited than mine. I don't know. Maybe I'm in YouTube jail or something, but if you can do it, you
yeah,
might as
it's
well.
I don't know what it is about. I mean, I remember when I was trying to learn macro, it was like I would watch, I would just absorb everything. Like starting in 2020, I would literally sleep at night, every night with Bloomberg TV running, like in the background, like classical music for babies sort of thing.
Hmm.
Uh, and I would watch macro podcasts, like serious ones, right? Like not some Yahoo like me on a trader's show. Like I'm talking like I would listen to the PhD, speeches at, the
Princeton.
Manhattan Institute or
Yeah.
yeah,
Yeah.
Princeton, and the real nerds of the nerds in the macro world. And like, if I heard a term that I didn't understand, I would try to figure it out and really like grasp it, kind of teach myself. Like I didn't read a textbook. I just literally kind of like forced myself to understand it on my own and really kind of, and the whole time I was thinking to myself, man, like it'd be cool if there was some guy that was in this macro world, right, that like took the time to explain things in terms that I could understand. Like I shouldn't have to spend tens of thousands of hours nerding the f out, right, like to understand the way our financial system works or how macroeconomics works. And so yeah, it was just kind of like that's why I started the Twitter account, or kind of really got involved with the Twitter thing, was the same thing. And then yeah, the YouTube was just kind of a natural extension. I think that right now, fourth turning, I think there's a lot of hunger, it seems, from normal people, on their nightly news channel, right? CNN night, Aaron Burnett's show, right? Like every single day, there is a segment on the bond market, tariffs, the dollar, right? So the normal people are hearing about all this stuff and they don't know anything. And it's not their fault. It's the fault of
Right.
the public education system. And so I think there's like, yeah, I think it's the right time. I think if we were not, like if this was under the prior administration and everything was just kind of, doing what it was doing, I don't think that the channel would have done nearly as well. I think it was just the right time mixed with the climate, and kind of fourth turning sort of stuff.
Yeah, my content is kind of like at the mercy of the market. So when we had like February through April was great. I mean, like, but when there's just like the melt up. So I would say it's like my views is kind of like a chart of the VIX. Like,
Yeah.
it's like you can watch it. It's like an inverse ETF. So whenever stuff's going on, the views will go right up. But when we're having melt up, doesn't matter how right you are. Doesn't matter if you called it. Doesn't matter if you made a ton of money doing it for yourself and everyone else. Nobody cares as long as they'd rather you say the market's crashing and it's not. In order to be interested. But yeah, it is what it is. But yeah, I'm glad you're doing well, and you're absolutely killing it out there. And honestly, I think we talked about it before too, when you were doing just like the tweets, and I don't think you were really doing spaces yet. But I was like, yeah, come on YouTube. It's easy. You
Yeah,
know, it,
it's a good format
yeah.
for like you can like I prepare slides and go through like because it's kind of hard. I would do those long Twitter posts, like those long threads or whatever, and
Right.
it was just
It's hard for people to
it's
engage in
hard.
that. Yeah.
Yeah, yeah.
So, all right, let's just wrap up here. So overall, yeah, I mean, 5%, 30-year right now. It doesn't seem to be bothering. Let's just get like a quick, maybe a near-term kind of look here into like Q3-ish, Q4. 30-year, that 5% isn't really bothering the market right now. Is there a price maybe where that does, or is this just kind of, is it more related to just kind of speed of the increase, if there should be one?
Yeah, I think it's the velocity. I don't think there is a level. 5%, like you said, doesn't seem to be bothering S&P or Nasdaq. So yeah, like I think that the trend or the bias
Hmm.
is towards higher rates at the long end, and a weaker dollar, medium to long term. Uh, I think that the bounce that we've seen in the dollar is probably close to over. It was looking kind of toppy when I was looking at it earlier today. So I'm not sure my chart got all
It
screwed up.
it
Uh,
had a pretty there was a lot of shorts in it, but usually when something's going to
that need to get
squeeze,
rinsed out.
yeah,
Yeah.
usually when there's something's going to squeeze hard though, it'll really do it, and it's kind of just it's like bouncing out of necessity. It's not really
Right.
convict. Maybe if there's a quick macro trigger, it could get a pop, but it doesn't look as strong as I would think, given how many shorts are in it.
Yeah, look, we had negative real rates of like 15, 16% the last time that Fed and Treasury were in fiscal dominance. This is not like I guess the kind of the scary thing is like, and why I wouldn't really want to be short bonds, like short TLT, for example, as bearish as I am, uh, if if things get long end rates drift higher, the curve steepens, and eventually, like I said, I think that there is a level where those long end rates become so restrictive that they have to QE or operation twist or something like that. You don't want to really be on the other side of that, right? So like,
Right.
I don't. The thing with bonds is like it's more that I worry about like older. I worry about a repeat of negative 15% real rates. This is the 10-year down here minus 10-year minus inflation, CPI inflation rate year over year. And yeah, here in 46, it was, negative 16%. It was even worse in Europe. So it was like negative 30% in
Yeah.
Europe
Yeah.
and 40% in Japan. So like that sort of thing, like I worry more about that for my parents, my grandparents, older folks, because I'm super bearish long-term bonds, but like I wouldn't really want to short them, especially here, after they've made such a significant move already. But it's just I think that the TLT over gold chart says it all, even including dividends. So yeah, like I could not be more bearish on long-term bonds. Short-term bonds, I think that if we get that shadow Fed sort of thing where they're using that forward guidance tool to guide down short end rates, maybe like something like twos as a trade might be good. I could see like buying the 2 year here as maybe somewhat of a short to medium term trade. But like again, it's just eventually they're going to run negative real rates in the bill
Right.
market is kind of what it seems like. So like, do I really want to own any government? I mean, the twos are at 387. Like, if they take the federal funds down to 50 basis points, like that could be a trade, right? But yeah, I don't know. I think equities, like I'm just so mixed because I think that eventually there is a steepening of the yield curve. There is a 10-year yield and a 30-year yield where equities will just not like it. It might not be today, right, with a 30 at 5, but maybe it's a 30
Yeah.
at 5.5. Maybe it's a 10 at 5. Like I don't really know what that level is, but I do know there is a level. And like we were talking about, if you look in gold terms, like S&P over gold, or Nasdaq over gold, or Dow Jones over gold, certainly over Bitcoin, they're not good looking charts. They're not strong looking charts. You go back to like the mid 60s and the early 80s, politically, like a lot of things feel awfully similar to that kind of populist era. And of course, kind of monetary reordering that we ended up seeing in 71. So like, yeah, in dollar terms, like as we were showing with the Turkish stock index, in dollar terms, yeah, the S&P can always go higher. NASDAQ can always go higher. It's just that I don't, it's not the place that would want to be. The other side of it is, we could see like a, 5% pullback anytime that like all the normal people in my life start kind of asking me investment questions and, oh, should I buy this or this stock? And
Yeah.
it's always like the crazy I always kind of think, maybe we're, at a top. So like, that's always possible too, is like, I've had a lot of that recently, asking about this and that, like out of nowhere, just over the past 2 weeks. So that makes me think maybe we're in for like a 5% pullback. But yeah, like fiscal dominance regime, look, in dollar, when the denominator is failing, and SPY is a dollar denominated asset, QQQ is a dollar denominated asset, sure, like they can go up pretty violently. I just think that the better expression of that trade, of that kind of denominator failing, massive fiscal dominance, like massively negative real rates, just out of necessity to service the debt. That sort of emerging market like phenomenon. I just think that like gold and Bitcoin are a much better expression rather than equities. But that's not to say that equities can't rip up
Right.
another 20-30% this year. Like if this kind of starts to become if we see that next Fed chair appointed, in the next month, and they go out and they're mega dovish and they're just banging the table, we're going back to ZERP and QE. You could see some crazy stuff, like a very violent blow off top.
Yeah, and so you were saying like you don't find you don't find equities attractive for those reasons, but at the same time, it would probably not a good idea outside of maybe a trade or whatever to try and fight them because if anything does happen, they're going to be quick to put liquidity right back in, and it's just going to be then you're going to be losing to the denominator and the nominal, which is double, it's a double negative essentially.
Yeah, I mean, you made that point about the S&P 500 not being allowed to decline.
Right.
I will just show this as the last chart of the day. Here's the S&P 500, and here are tax receipts. They are basically the same chart, right? So yeah, we become so hyper financialized that when you have these declines in the S&P 500, they pull down tax receipts, right? This is one side of the balance sheet for the government, other side being expenditures. Well, what causes equities to decline? It generally recession, right, and poor growth. So in that environment, expenditures are going up due to automatic stabilizers, employment programs, things like that. So really what you get is a widening of the deficit. The deficit gets worse. Well, we are already running at a 6-7%, really 7% fiscal deficit, unheard of outside of a world war or major economic catastrophe. So yeah, like there's a degree to which they really can't let financial assets fail. And as time goes on, more and more of our tax revenue overall, right, the total overall revenue that we see here in this red line, more and more share of this revenue is coming from capital gains tax. And I did a post a long time ago with tax foundation charts that show that. So like the more financialized we get, the less they can let certain financial assets fail. I would caveat that with like bondholders. It appears like bondholders need to lose money in real terms. So yeah, but for equities, it's certainly a great point.
Right, and it's like the more that they stopgap it, it's like a feedback loop. It's like the more they stopgap it, the more it gets wound up, and then the more dependent it is, and then it stopgaps, and then it's wound up, more and more and more. So, like you said, it just becomes a higher percentage share every
Yeah.
single time that they keep having to do these things, which is basically every day at this point.
Yep. Yeah, I think that it's one of those things that you don't want to be calling for a 70% decline. Some of these like mega bears
Right.
that think that like everything's gonna collapse. It's like you are fighting against the Fed,
Yeah.
the plunge protection
Larry
team.
Fink.
Yeah,
Yeah.
like
Yeah.
I just
Yeah.
I don't get it. I
Yeah.
really don't get it.
Yeah. So I mean, yeah, you can you make trades and whatnot, and you know, uh, I always say as a trader you have to be able to do both sides. But yeah, I
Yeah.
mean, you can't. I've been doing this long enough to know that that's just not gonna. They're not gonna let that work.
Yeah, I also like the Swiss franc. This is something I've been talking about since like February-ish. And it's if I had had the guts to put on like a futures position on the Swiss franc, it would have done really, really well. But yeah, like I like the Swiss franc kind of long term. They tried to run the Swiss franc was strengthening so much here. I'll invert it so that it's in Swiss franc
Hmm.
terms, right? The Swiss franc has been in one of the only currencies to actually strengthen versus the dollar, going back to like post GFC. Literally one of the only currencies. And recently, it showed mega strength. It was showing so much strength that the Swiss central bank took the 2 year down to like negative rates to try to stop flows into the Swiss franc. It was strengthening so much, and it still like since they started that in April, it is still strengthened even since April. So like even that policy of having negative rates. I think that the Swiss 2 years like negative 25 bips. Even that hasn't stopped flows into the Swiss franc. So
Sounds
that
like
is telling you something.
sounds like
You know?
Japan almost, where they're
Yeah,
trying to
like
fight that.
yeah, exactly. BOJ. Yeah.
Yeah.
I think that that is indicating something significant with the dollar. I think that a lot of those dynamics that we saw over the past, since April, with interest rate differentials blowing out from the currency and stuff. I think that there's something like I cannot be I've tried to listen to the arguments that everything's fine with the dollar and kind of there is no broader undercurrent of that is so dollar negative. I've tried to listen to those arguments, but like I just don't see it. I think that there are significant issues with the denominator, which for most Americans is the dollar. And yeah, you want to be short the dollar in those sorts of environments. And look, S&P 500's kind of sort of short the dollar, in a way. So you're at least not. Cash is probably the worst. Bonds are probably the second worst. Because even the yields that we have now are I don't think going to be anywhere close to compensating you over the next decade.
Well, and they're based on data that's really questionable, to say the least.
Yeah, and look, like you get back into that world that we were just kind of talking about, where can they really let the 10-year go to 7%, 8%, 9%, 10%? Not really. So you kind of enter that sort of that side of it as well, which is like they can't really let the bond market trade freely if things start to get. I'm not calling for a 7% 10-year in the next year, but if things got really spicy, like they would have to step in there as well. So yeah, like you're fighting against this. I mean, the plunge protection team literally, and I know it's not called that, but they answer only to the president.
It's called Trump's Twitter.
Yeah. Yeah. They literally have like no accountability to like Congress, right? They only answer to Trump. And so, yeah, like you're up against these guys. They got an unlimited money printer called, bank reserves at the Fed. So, yeah, they just take QE up by, 8 trillion.
I like to call him Uncle Scott,
Yeah, good luck with your, 80% S&P decline when they print $9 trillion in a day. Like the thing is going to rip so hard.
And we got to roll 7 trillion this year alone. Where's that going to come from?
Yeah, exactly. Like, look, the debt and fiscal dynamics are so bad. I mean, mandatory spending is 100% of tax receipts. Interest is over 20%. Just to put this in perspective, 20% of tax receipts going to interest. This would be like you made $100K a year, and 20K of that 100K was not paying down any principal, literally just going straight to interest on credit cards.
Yeah. So they're basically finding out what it's like to be us, where we actually have to pay taxes on our income, and we don't get to, except that we
but they can print the difference.
Yeah, exactly. Well, all right. Well, I'll let you go, Infra. Awesome chat as always, and. Again, where can everybody find you on YouTube, socials, all that good stuff?
Yeah, on Twitter, I got the blue check, INFRAA_. And then on YouTube, it's infranomics. Those are. Oh, and I have an Instagram now, but I don't use it.
That's right. Yeah, Instagram's not that great for finance.
Yeah.
But all right, guys, if you liked the video, please give it a thumbs up. Go find Infra on his YouTube channel, Twitter, all that good stuff. Subscribe to me on carnivoretrades.com, and we'll see you guys all in the next video.